Hi everyone, this is a short basic screencast for Independent Colleges Dublin for F6 Taxation IRE for the December 2014 exam. And what we're going to be looking at in this particular screencast is question number 1 from the June 2014 paper, which covers income tax and income tax computation. Okay, so before I take you through the scenario itself, let's have just a quick look at the requirements for this particular question. We're going to deal specifically with A and B, and what we're looking at in requirement A is the assessable case 2 income for an individual, Brenda, for 2 years. And wherever we see that within a question, we've got to be thinking about base of assessment rules. In other words, which rules are relevant for this particular individual. And it's highly likely at F6 level that either commencement or indeed cessation are going to be examined. Okay, we can see that we have 3 marks here, so not a lot of marks. We need to get our answer down fairly quickly, and we need to be very, very familiar and very quick to deal with base of assessment rules. That's a key area of the syllabus. In this part B, we're asked to do an income tax computation, and really whenever I see an income tax computation in a question, I'm always thinking about easy marks. I mean, there certainly will be some tricky areas within this particular computation, I'm sure, because of the type of paper and the style of the examiner, but there will definitely be some marks to be had for doing not very much at all, from just literally copying from the question and putting these items into the income tax comp. And we'll see that the individuals concerned are jointly assessed. Okay, so obviously what that means is that we have a husband and wife, and we'll be doing just one computation. Okay, so we're looking to submit a computation to the revenue in effect with 2 sets of income, 2 sets of allowances, etc. Okay, so let me just take you through the question itself first, and you'll see that it starts off with some very basic information for these 2 individuals, Martin and Brenda. Now, the first thing that you'll see is that you're given ages, and you've got to be thinking to yourself when you're given an age, is any particular or perhaps additional tax credit relevant? In this case it is, and we'll see that when we look at the answer. You'll also see that obviously they're married, and the first thing you've got to be thinking about then is really what types of income will you be including in the top part of the income tax computation. And very much a list. There will be some tricky areas, but it'll be very much a list. Okay, we've got some Schedule E income, a pension that is taxable for Martin. You'll see that no PAYE has been deducted, therefore no specific tax credit on that, although there will be a deemed tax credit, as we know, of 1650. Okay. Next issue here is that we see that this individual, Martin, has some investment income. So we've got to be thinking about case 5. And you'll recall from your studies that there are quite a few little tricks in this area of case 5 rental income that can be played on you. And many of them are played in this area here. Okay. The first thing that they tell you about this investment property is that there's a loan. Okay. So we've got to be thinking of, is the 75% trick relevant in this particular case? In other words, where we have a residential property, what we should remember from our studies is that only 75% of the interest is relevant, as opposed to a commercial property where 100% of the interest would be relevant. The other thing that's interesting from this particular paragraph is the fact that the property was bought part way through the year. Yeah, so 1st of March 2013. Now that means that we're not dealing with a full year, and that's the typical way that tax examiners will come at this area of rental property. They'll ask you to prorate in some way either the income, the rental income, or indeed the expenditure, or perhaps both as is the case in this particular question. Now, what we see about this property in this paragraph here, I'll just take you through the basics of it, is that in effect there is a 3-way split. Yeah, there's a ground and upper floor, and the upper floor is divided into 2 apartments. So we can see immediately that we have 3 different sort of batches of income and expenditure to deal with. Okay. The other thing to notice here is that, aside from this area of the property only being bought part way through the our tax year, Each of the elements of the property are let at different times. In fact, one element, apartment B, wasn't let at all. So again, we've got another amount of prorating to do based on this particular date. We'll remember that expenses are only allowable for case 5 post-letting. So it's only the element of the expenditure from the 1st of July 2013 onwards for this particular part of the property that will be relevant. Other thing that we're shown here is a premium. We've just got to think about what the formula is for that. Remember, with a lease premium, part of the premium is deemed to be rental income, as it were, and part is deemed to be capital. So we need to extract from that premium the element of income and include it in the income tax computation along with the normal rents. Okay, we see that the upper floor is split into 2 apartments, which should be thinking back to this 75% element of the loan, and we'll see that apartment A is rented from the 1st of July also. Apartment B not rented at all. So remember our issue with regard to allowable expenditure post-rental. Okay. Now we give some details here on the expenditure associated with the properties. You can see that the total amount of loan interest is 20. We've got to think of what's the split. What's the 3-way split between commercial and residential, and then allocate that 75%. We've also got rates, which would be a commercial element entirely. And again, they're given for a period here. We've got to watch out for our dates. Same thing with the insurance. You'll see that it's for year ended 28th of February 2014. So again, a certain element of prorating. Just notice that it's a year rather than a period. So that's 12 months to that date. And we can only take out our relevant element. You remember from the item above here, that would be the 1st of July onwards. So in effect, 6 months of the tax year is going to be relevant out of that. Okay, we've got 1 or 2 other expenses here. We just got to remember whether or not they're allowable or not. We'll have a look at those when we look at the answer. Martin's other income. This individual wrote a play. Okay, and this is a very, very small area of the syllabus, but just the sort of thing that the F6 examiner will include in a question. Just a very small rule which relates to income which has some sort of cultural merit, and there may well be an exemption for that, an exemption from income tax, and just a rule that we just have to remember. Okay, we'll look at that when we look at the answer. A little bit of detail about Brenda here. She's self-employed. Clearly, we would have fixed on that from the requirement. It looks as if she's been operating a business on an ongoing basis for quite a few years, so she's certainly not in a commencement phase, so it must be the second option for us, cessation. We'll see that down below. We're given a little bit of information here about HSC and some withholding tax deducted. Again, that's a small rule, and really what it relates to is an element of tax credit that would be deductible in the income tax comp, and we just got to figure out what rate of tax credit would be relevant. We're given some details about her situation, i.e. cessation, as we thought, as at a specific date. So again, these bases of assessment rules for cessation have got to be at the forefront of our mind. Hopefully you'll remember that the actual basis is relevant, so 1st of January through to cessation date, but there's another trick in there, and hopefully you'll remember that from your studies in relation to the penultimate year. We're just given the basic information in relation to her trading results, and we have to cut that up really based on the base of assessment rules. Some further information here in relation to equipment. Okay, so just to remember on cessation of a business, really we have a cessation date, and we're looking to really compare the tax written down value to the market value, or indeed perhaps the proceeds, and you'll see that we have a tax written down value of 12 and then a value of proceeds in effect of 10,000 there. So we have to look at a comparison to see whether or not we have any either allowance or charge. Items here, you'll see that various outgoings for each of them with 1 or 2 tricks in there. We've got this issue of the pension. As soon as we see that, the standard trick where we see pension contributions is going to be, well, you know, if she's paid out 8,000, is that going to be wholly deductible in her income tax computation based on her NRE? And we'll remember that NRE stands for net relevant earnings, and the only way that we can establish those is by obviously knowing the rules, but also by looking at that element of her age. So age times NRE is going to give us the max amount that she can deduct in her income tax computation. One or two other things here of interest. It looks like she's subscribed for shares in some way, and those shares look to be EIIS relevant. So, what are the rules there? It looks like we've got a €10,000 subscription. And again, we've got to be able to figure out how we deal with this within the income tax computation. Certainly, it'll be some sort of deduction, but, when and how does the tax relief kick in? Okay, so that's the basic question. Let me take you through the answer now. And you'll see within this answer that the first part is reasonably straightforward if we know the cessation rules. Okay, so this is part A for us. We'll see that part A referred to just simply laying out some case 2 income details for 2 years, for 2012 and 2013. Now, we'll remember from our studies, hopefully, that where an individual has a cessation date, in her case, the 30th of June 2013, the first thing that we do is fix on what the cessation year is. And because of the fact that 30th of June sits in the 2013 tax year, we know that 2013 is the final year, okay? And that must mean that 2012 is the penultimate year. So hopefully we'll remember that there is a sort of a penultimate year trick, something that we have to do. It's a requirement under Irish tax legislation. We have to do some sort of comparison, and I'll take you through that in a moment. Now, in terms of their answer, quite well laid out. You don't necessarily have to do it in this order. What they do first is they say, okay, well, there's something, there's an issue with regard to the penultimate year. So let's lay out what the original assessment was for the 2012 year. And, the 2012 year was an ongoing year, okay? That was a year that she was in business, though she wasn't ceasing or indeed starting. That was an ongoing year. What's the basis of assessment for an ongoing year? Well, that's always going to be the current year basis. Now, what does that mean? Well, really what that means is we're looking for a 12-month accounting period ending in 2012. And you'll see that, we do in fact have that. We have a 12-month accounting period of 31st of August. You'll see that from the question itself. So we're going to get a half a mark just for laying out what the original assessment was, okay? But we need to do it fairly quickly because, as we've seen, 3 marks here, so we've got around about 5 minutes to lay this answer out. So there's the first part. They lay out the original assessment. Then they go to the final year, and as mentioned when we went through the question, actual is the base of assessment. And the important thing here, other than recognizing that actual is important, is that we need to be clear on our dates, and indeed our fractions. In this particular case, what they've done is they've given you a period that is not 12 months long, and that's pretty typical of the F6 examiner. So really what they're looking for you to do is to say, well, if actual is relevant, then that must be 6 months, i.e. 1st of January through to the 30th of June 2013. Therefore, for a 10-month period, because the period in 30th of June 2013 is 10 months, I need to take 6 months out of that. And that's where we get this figure of 21.6, okay? And a mark for that, which is quite good news. Okay, so that's really the final assessment for the final year. We have to then look at that revision. We said we talked about this penultimate year trick here. So what do we need to do? Well, really what we need to do is compare what we had for the original assessment up here to what the actual basis is for the penultimate year. And you'll see that when we do our little calculations, some fractions are required. As you'll see, we do our calculations, we get to another, in fact, higher figure, 39,733. So what we have to do is we have to say, okay, we've done the penultimate year trick. The penultimate year on the revised basis is 39,733. What was the original? The original was 38. Therefore, we're required to increase. And you'll see here that the revenue or the inspector of taxes will be looking for an upward revision to the penultimate year. Okay, so that's what gets us 3 marks. Okay, now this second part here, part B, we have the income tax computation. Now you remember what we said within the question itself. We said that we have 2 individuals and they are under what we call joint assessment. Now what that means simply is that we're going to have really one standard income tax computation for both of them. So we're really just throwing in all the income relevant to both individuals. So what I'll do, because there are quite a few workings here, I'll take you through the main workings, i.e. the ones that involve a little bit of work. Now you'll see from Martin, obviously we had Schedule E there, and that was just a straight slot in from the question. The Schedule D bit, in terms of the rental income and the Case 2 income, a little bit more complicated. We deal with the Case 5 first. We've got a working here, which I'll go down to in a moment. We see working number 1, and we've got a figure of 23,490. So you remember what we said earlier on, we had basically one property that sort of was split into several parts. Okay, so this working 1, as you'll see, from the question here, the format is columnar. So we have 3 separate columns. We had a ground floor for the commercial, and we had the upper floor really split into 2. Okay, now you could do it as one column, but I think it's a little bit easier given the fact that there are lots of little tricks and little calculations. I think it's easier to lay it out into 3 columns. Okay, so the first thing that we need to do is obviously set up the working and say, you know, Case 5 income, and then let's deal with the rental part first, i.e. the rental income plus the element of the premium. Now you'll see that across the top here we just have a series of figures that are taken straight from the question. I'll show you the part number 1 now. We just move down below. The rental income side, the commercial property, we were given the annual rental. And you remember that we said that the property wasn't purchased until March of 2013, but then again, it wasn't let until the 1st of July. So we can only take half or 50% of the annual rental, and that's where we get the figure of 18,000. Apartment A, again, only rented from the 1st of July. So that can only be 6 months worth, and that's where we get the 5,400. Apartment B, not rented at all in our tax year. So you often find that the rental income side of Case 5 is fairly easy to deal with. In other words, getting the income right. It's really where the expenditure is messy that can cause some issues. So there's the top line there in terms of pure rental income. And then we've got this lease premium. And you remember I mentioned the formula that's relevant where you have a premium split between really income and capital. So what we have to do is multiply the premium, times 51 minus n, or the length of the lease, and then just divide by 50, and then we're going to get the income element. We're just going to add that into income. Okay, so if we go up above here, look at our next part, you can see that's where we get the split between rental and the premium. So that gives us our figures of 28,800 and 5,400. Obviously nothing for apartment B because it wasn't rented at all. Now in terms of the expenses, you'll see the way that they lay them out, just literally one by one. And you know, certainly within questions of this type, you know, some of the areas, some of the expenditure may be quite complicated, but really what you've got to do is you have to act quickly and make decisions. You know, the important thing for you in this type of question is really to get down to some sort of, you know, net rental income to include in your income tax computation. In this case, it's 23,490. You know, if you don't get to that figure, if you spend too much time trying to, you know, get these 100% right, then you're going to run out of time in the question. So, you know, if in doubt, make a decision and indeed move on. Okay, so I'll take you through one or two of these. You know, the interest on the loan, this part 3 here, we have 6,000 and 225. Let's take a quick look at that. So what we'll see is the loan interest that was relevant. Remember that he bought the property on 1st of March. Obviously, our tax year end is 31st of December. What's relevant is 20,000 as a total amount. But you remember what we said is that the interest can only be applied post-letting. Okay, and over and above that, it's split three ways. So again, we've got the three columns for commercial, apartment A and apartment B. If this is the total amount, we need to split between each of the three elements, okay? And then we need to look at this area of post-letting. So what they do is they split out the total amounts here on first line, and then they say, well, what element of that was post-letting? Well, essentially, it's going to be just 6 months worth. Yeah, so in effect, we're saying really 6/10, as it were, given the fact that we're excluding January and February within the tax year. So that's certainly relevant, and the 3,000 is the same. In effect, we're saying 6/10. But for the residential side, you'll see that we have to apply that 75%. So that's where that figure of 2250 comes from. Okay, so really, this is the figure that's relevant, and this is the one that you'll see above. Okay, so if we go above, excuse me, if we go above here, you'll see the 6 and the 2250. Okay, now the rates are same sort of thing. I won't dwell on that because it's the same sort of calculation. Notice that the rates are obviously relevant only for a commercial property. They don't affect the apartments in any way, shape or form. We'll take a quick look at the insurance. Couple of slightly fiddly adjustments here. This is item number 5. Just take you down to that. You'll see that the information in respect to the insurance was given to us for the year ended 28th of February 2014. So really what we had to do is to say what element of that is post-letting. And really what's relevant is really 6/12, which would give us 600, okay? And then what we have to do is really to apply that between the commercial and indeed each of the apartments. So in effect, we're getting 6/12 of the figure that was included within the question, okay? So if we move back up to the main working here, what you'll see so far is, a fairly straightforward income calculation, and then a little bit of fiddliness in relation to the expenses based on prorating months and dates. And that's, as I said earlier on, is the typical way that the examiner would come at this area. No relief for the NPPR, but PRTB would be allowable. Just something that you need to remember, just small items. But, if you hadn't got that, certainly what you're aiming for is to get a figure down here as quickly as you can. Okay, so there's the case 5 income that we would include within the income tax computation. I'll just take you back up again to the question itself. So what you'll see is we've dealt with this case 5. That's coming straight from the workings. Draw your attention to the format and how clearly this answer is laid out. Obviously, the examiner and your markers have the benefit of time, and that we don't in the exam. But really, do try to annotate your income tax computation with your workings. Okay, this case 2 element here was actually fairly straightforward. We have income that's of cultural merit in some way for Martin of 45, and all we had to do is just to remember that where income is of cultural merit, then we have a 40,000 euro exempt amount, and we just really had to take one from the other to get the 5. Okay, so that's really Martin's income dealt with. If we look at Brenda's income, you'll see that, again, we're just sort of listing down what's relevant to her. Now, we know from above, from the figure above for Part A, that we had 21.6 for that final year. Remember that we had the penultimate year trick, but that doesn't affect the computation for 2013. It only revises the computation for the penultimate year, i.e. 2012. Okay, looks like we have a capital allowance adjustment here of 2,000. Obviously, capital allowances are going to be deducted. We'll have a quick look at that note now. That's note number 2. Bear with me one second. So, note number 3, in fact. So, what we have here is capital allowances. Now, what you'll remember is that this individual is ceasing. So, in effect, on that date, we're looking to compare the tax written down value that we're given with any proceeds, and that happens to be 10. Because of the fact that the tax written down value is less than the proceeds, in effect, the revenue have underestimated the allowances or the capital allowances that are available. So what we've got to do is say, okay, this is the tax written down value. Let's compare to the proceeds. The difference, obviously, is going to be a balancing allowance. Okay, so we've moved back up the comp. Bear with me 1 second. Okay, so that gives us this figure of 2. Notice that the way that they show the obviously the case 2 income and the capital allowances separately, and then give us a total figure, although they haven't told the difference between the two. We'll need that for NRE. Okay, so that gives us the income for both individuals. Let's look at the reliefs. Okay, now the first thing here, this was queried in the class, this payment to carer. I think what they're talking about there is health expenses paid out rather than an employed person. That's why they give a full deduction. Okay, this next one here, I mentioned pension contributions, and invariably with the F6 examiner where pension contributions are paid by an individual, the standard trick is going to be that the pension contributions may in some way be too much to be fully allowed within the tax year. So let's have a quick look at note number 4, and we'll see if that is the case, because I think it is. Bear with me 1 second. So note number 4, we've got pension contributions. Okay, now what we need is Brenda's net relevant earnings, NRE, and you remember that net relevant earnings are really, case 1 and case 2 income plus non-pensionable case or Schedule E. Yeah. So if we look back up the comp, you'll see that the difference between the assessed case 2 income of 21.6 and indeed the capital allowances of 2,000 is that figure there. You won't actually see that figure in the comp, but it's basically a net off. So the calculation of the NRE was fairly straightforward, but what we would have needed to do, given Brenda's age, is go to the tables and make sure that we picked out the right percentage for her based on her age. So with pension contributions, we're looking to multiply the relevant percentage, in this case 40, times the NRE. And what we get there is obviously a figure of 7840. And I seem to recall from the question that the total pension contribution paid out was in fact 8,000. Therefore, any balance on that would be carried forward to the following year. Okay. The next point in the question was this issue of the EII. In other words, the investment for subscription of shares. So really what we've got there is a deduction of 7,317. Now, we could have done this slightly differently. We could have put a tax credit down here in terms of the tax relief. Let's be clear on what EII is. Really, all that we're doing is saying that this individual has subscribed or purchased some shares, okay, some shares in a given entity, and that entity is qualifying EII. In other words, over and above, hopefully, an uplift in the value of the shares, this individual, because they've subscribed in a qualifying company, are going to receive some form of tax relief, some form of additional tax relief. Okay, so really, as I said within the question, it's a question of, well, okay, they've subscribed for some shares. How much relief are they going to get, and when are they going to get it? Okay, so if we look down at working number 5, if you bear with me 1 moment, we'll see that the sum invested was 10. Okay, so that's the subscription value in the shares. And what we should recall from our studies is that for EII, the relief is in effect 30% in year 1 and a further 11%, if that's relevant, in year 3. Okay, subject to a max of 150, which isn't relevant in this particular case. So really what they're saying there is that, yes, you can make an investment in shares in a qualifying EII company, but in terms of the tax relief that you get, you're only going to get 30% in year 1, and you need to hold the shares for 3 years in order to obtain that element of 11%, or the differential for the full marginal relief. So what they do, and they could have done this differently, is they say, well, that's the investment. If the excuse me, if the deduction in year 1 is in effect 30 over 41, 30% in year 1, then that's the value of the deduction that we can take within the income tax computation. And what that does in effect is give the individual 30% relief in year 1. Okay, so back up to the question itself. You'll see that that's 7,317, I believe, is simply deducted just there. Okay. Donations to charity, not deductible at all. You'll notice that they've actually put that in. They've put a 0 in there. Watch for that. Okay, so watch for charitable donations. They're strictly not allowable in any way, shape, or form, or indeed not deductible, but they've shown the fact that they aren't deductible. So rather than just ignoring them because they're not deductible, you won't get that mark of 0.5 unless you put them in and put in a 0 value. So just watch for that. Some easy marks there if we can remember it. So really what we've got in total here is we've got the total income. Yeah, we've got a series of deductions, a couple of tricky bits in the workings for sure. The difference between the two is what we call our taxable income. And obviously with a married couple, because she has sufficient income, all of that's going to be at 20%, giving us that figure of 8787. Okay, now here's some easy marks for us here, and I think these are the sorts of marks that I mentioned when we looked at the requirements of Part B. There's some easy marks here for doing very, very little. Obviously, we've got the married person's tax credit of 3.3, the PAYE deemed credit, as it were, even though no actual PAYE was deducted, of 1650, and just remember, things like the age credit, and that's 490 for a married couple. And then we have the PSWT, that was the refundable tax credit in relation to the HSE work of 20%. So again, that's just deducted. So quite a few easy marks here. We simply take the tax at 20 less the relevant credits, non-refundable and refundable, and the difference is the next tax, the net tax due. Okay, so hopefully that's a helpful summary of this particular question, or at least part A and part B, and hopefully that helps you for your studies for the December 2014 exam.